Hello everyone, welcome to the 148th episode of me learning how to trade in Forex. So in the last episode we went through should you invest in offshore securities. Basically investing in markets other than the one in your country is a good way to introduce diversification into your portfolio, as offshore investments create distance between where you earn your income and the performance of your portfolio. So if your local economy is struggling, your overseas investments could remain unimpacted. So it also introduces currency diversification. Either need to buy foreign currency to purchase shares or use your local money to buy stocks in the companies that trade in a foreign currency. This could benefit you if you're able to capitalize on the currency movements to boost your profits or buy at a more beneficial prices. So so in this situation, performance of your portfolio won't be determined only by the value of the shares, but also by the value of your currency. So, for example, the value of the shares might decrease, but your portfolio could stay in the good due to the currency conversion. And should your base currency weaken against the shares currency, the money you get for one share will increase. And I went through an example for this, did the quiz, and when you invest in offshore, it's important that you're aware of the additional fees incurred from converting the currency. So every time you buy and sell currency, you pay a small conversion fee. So an offshore investment can protect your portfolio by providing an opportunity to earn an income in a market that isn't affected by the same forces as your home market. Even though most of the developed markets are broadly affected by similar events, it's not uncommon for one market to be on a bull run whilst another enters a bearish run. Okay, and then we went through the lesson summary, and now we're on to the analyzing the markets you want to trade. Analyzing the markets you want to trade. Date is the 27th. Let's get started then. It's not uncommon for new investors to stick to blue chip companies, being established, reputable and financially stable firms, or exchange traded products such as exchange traded funds. Exchange traded funds. I don't know why I can't say it. So buying shares in a global exchange traded funds is a good way to broaden your exposure. While it's a good strategy, it's not one that will outperform the markets. By design, exchange traded funds can only offer the average return of the market they track. So by design, the exchange traded funds can only offer the average return of the market they track. There are thousands of listed companies around the world. Some of them will experience meteoric growth, others will potter along for a decade, and the rest will fold completely. If you want your portfolio to outperform a market, you must learn how to identify investments that will experience good growth in their lifetime. So how do successful investors choose shares? Let's find out. So if you want your portfolio to outperform the market, you must learn how to identify investments that will experience good growth in their lifetime. So the basics of fundamental analysis. Listed companies around the world are required to disclose financial and operational information. Using these publicly available details to determine whether to buy or sell a share is called fundamental analysis. So fundamental analysis. Using the publicly available details which listed companies around the world are required to disclose label details such as financial and operational information. So using the publicly available details such as financial and operational information, which listed companies around the world are required to disclose, to determine whether to buy or sell a share. Using the public to determine whether to buy or sell a share. Yep. It's called fundamental analysis. Having access to this information on a company makes it possible for shareholders to compare two companies using the same metrics. So, having access to this information on a company makes it possible for shareholders to compare two companies using the same metrics. For example, say you're considering investing in company A and company B. They operate in the same industry and have an equal market share of their sector. You find that company A has more employees and therefore higher operational costs. From this information, you could conclude that company A is less operationally efficient than company B, making the latter a better investment. However, your analysis should consider different outcomes because details about both companies could lead to opposite assumptions. For instance, you could just as easily conclude that company A is better because company B isn't well positioned to handle increased demand should there be a shift in the market in the future. Alright, so the same factor could be analyzed in different ways. So it could be good, it could be looked at in a good way, or it could be looked at in a bad way. So yeah. Access to this information also makes it possible to measure the performance of a company over time. Your analysis should consider both the positive and negative outcome, as the same details could lead to opposite assumptions, i.e., more employees could mean that the company is less efficient. However, it could also mean that it's more suitable to handle higher demands in the future. This information, access to this information also makes it possible to measure the performance of a company over time. Also makes it possible to measure the performance of the company over time. This will help you work out if the company is doing better or worse than when you invested in it. So this will help you decide whether the company is doing better or worse than when you invested in it. Consider the same example. Company B might increase turnover with the same workforce, making it more profitable, or it might employ more people and still produce a similar turnover, meaning its cost base is growing but its profit is shrinking. For a long-term investor, understanding how the company you're investing in makes its money is critically important. It's crucial to understand how the company is making it's crucial to understand how the company is making its money as a long-term investor, especially if you buy individual shares. Buying shares is buying ownership of a business, just as you wouldn't buy a franchise without properly analysing it. The same due diligence should go into buying shares. When you're ready, take our fundamental analysis course where we explain the concept further and how you can put it into practice. Understanding technical analysis. Long-term investors tend to favour fundamental analysis. However, market participants could also benefit from using another way of analysing a company's performance called technical analysis. For those that use this method, the main thing that matters is an asset's share price. It's often favoured by active market traders who buy and sell multiple shares or contracts in a day. A technical analysts won't normally pay special attention to a company's annual finance reports, but rather the impact on its share value. Technical analysis could also be used to analyze a company's performance. The main thing that matters is an asset's share price. It's often favoured by active market traders who buy and sell multiple shares or contracts in a day. A technical analyst won't normally pay attention to a company's annual financial reports, but rather the impact on its share price. A technical analyst won't normally pay special attention to a company's annual financial report, but rather the impact on its share value. Did you know market traders, unlike investors, often look to capitalize on shorter-term price movements? They normally hold on to assets for brief periods which can range from seconds to weeks. Technical analysts rely on price data and the conclusion they can draw from their findings to make decisions. They use charts, indicators, drawings, and different date ranges to answer just one question: will the price of this share go up or down? So technical analysts seek I like that word, seek answer to the question of will the price of this share go up or down? Many investors and traders spend years perfecting a system that tells them at what price to buy and sell an investment. You can learn more about how to do this in our technical analysis course. Using a combination of both fundamental and technical analysis could help you make important decisions about your investment. So use a combination of fundamental and technical analysis. Lesson summary. Before you put your money into the markets, you have to properly analyze an asset. Your analysis will give you clues about whether investment is worthwhile. Fundamental analysis relies on the overall standing of a business, while technical analysis focuses more on the price movements. I think that's a nice summary there. Fundamental analysis relies on the overall standing of a business, while technical analysis focuses more on the price movements. The importance of diversifying your portfolio. So the importance of diversifying your portfolio. Diversification is your first line of defense against risk in your portfolio. Diversification is your first line of defense against risk in your portfolio. It's a practice of allocating your funds across a range of investments to limit exposure to a single type of risk. So it's the practice of allocating your funds across a range of investments to limit exposure to a single type of risk. An undiversified portfolio is one that has holdings in assets that are too closely related, and this could result in higher losses during a downturn. So, an undiversified portfolio is one that has holdings in assets that are too closely related. This could result in higher losses during a downturn. For example, say you own shares in a local fuel producer and a local transport company. If your country experiences a long-running oil shortage, both your holdings will be impacted because the oil and transport industries depend on each other. The fuel producer would lose profits due to the limited oil supply, which could mean decreased sales. Subsequently, a fuel shortage will likely result in price hikes that could impact the transport company's bottom line. And depending on the severity of the shortage, the transporter could also face operational challenges if there's no oil available to fuel its vehicles, or lose more money to importing supply. In the scenario above, you bought shares in two dependent sectors within the same geographic location and economic environments, so any dramatic changes to one could directly impact the other. So, when buying shares in two dependent sectors within the same geographic location and economic environment, in the same geographic location and economic environment, any dramatic change in one could directly impact the other. Think about what would happen had you also bought shares in an oil company from another country, one that's one of the biggest oil producers in the world, for instance. Think about bought oil company from another country. Country experienced a long-running oil shortage. So if you did buy in shares from an oil company from another country, then you should be fine, right? But you're one of the biggest oil producers in the world. So if your own country is, what is it? Having a long-running oil shortage. So that means the demand is higher than the supply. So the demand is higher than the supply, then the price of oil is going to go up. So if the price of oil goes up, and you had bought shares in that oil company from another country, then your share price will also go up. So then that would, I guess, offset the risks or the losses, I guess, of your local fuel producer and local transport company. Because while these two decreases, your shares in an oil company from another country is going to increase. So, yay. Homework. Make a list of 5 assets you may want to invest in and put them into a table like the one below. Make sure you look up any information you're unsure about so that all the details are as accurate as possible. We've placed 3 examples below to help guide you. You'll see from the examples that 2 of these assets are equities, but each of them is from a different country and is priced in a different currency. So, holding, Volkswagen. Market, Germany. Currency, euros. Asset class, equity, shares. Sector, motor. British Airways, Great Britain, GBP, equity, shares. Travel, Gold Bullion Securities Ltd, USA, USD, Exchange Traded Fund, Commodities. There are many ways you can diversify your portfolio. As you've seen above, you can vary your investments by the countries, sectors and asset classes you buy, and even the currencies you use to do so. So, there are ways to diversify your portfolio. Vary your investments by the countries, sectors, asset classes, currency used to do so. Cheeky. Yeah, that looks good. More advanced market participants can use different financial instruments such as CFDs and spread bets to diversify their portfolios. We'll take a deeper look at this into the next lesson. We'll take a deeper look at this in the next course. So CFDs and spread bets. Okay, so currency used to do so. Financial instruments. Different financial instruments. So CFDs, spread bets. So, lesson summary. Diversification can help protect you against major losses. It involves buying a variety of assets in different regions, currencies and sectors. You can also diversify your portfolio by the financial instruments you choose to buy or sell. Okay, building a second tier portfolio. So, building a second tier portfolio. Building a good investment strategy can take months of research, but once you put it into action, there's not much to do but wait and monitor your growth. Save for a few adjustments you make as needed. Instead of passively waiting for their money to grow, some investors choose to take a more active role by building a secondary portfolio of speculative shares. This involves selecting shares with very high prospects for growth, such as bagger stocks. Bagger stocks or baggers are investments with values that increase by several times their current price. For example, a 2-bagger stock is an asset that doubles in value, while a 10-bagger stock would be one that increases tenfold. The term is now used for any company with an explosive growth prospects. Whilst investors wait passively for their investments to grow, some choose to take a more active approach by building a secondary portfolio of speculative shares. This involves selecting shares with very high prospects for growth, such as bagger stocks. This involves selecting shares with very high prospects for growth, such as bagger stocks. Bagger stocks meaning investments with values that increase by several times their current price. Investments with values that increase by several times their current price. This strategy carries a higher risk than traditional investing, and there's a possibility that these types of shares won't amount to much or anything at all. For this reason, it should ideally make up a small percentage of your overall portfolio. This strategy is high risk. Therefore, it should only make up a small percentage of the portfolio. As with your long-term investments, you should have a written strategy in place for your secondary portfolio. There are a few points to consider when you build one. How financially prepared you are to participate, for instance. We've put together this list of questions you can ask yourself before using the strategy. So, questions to ask yourself before making a secondary, before building a second tier portfolio. What impact will this portfolio have on my ability to build wealth in the future? What impact will this portfolio have on my ability to build wealth in the future? How much am I willing to put towards speculative investments? How much am I willing to put towards speculative investments? What type of investments am I looking for? Type of investments am I looking for? Here you can consider companies in certain speculative sectors, for example artificial intelligence, companies with small or medium market capitalizations, companies listed in developing economies. So can consider companies in certain speculative sectors such as AI, companies with small or medium market capitalizations, companies listed in developing economies. Companies listed in developing economies. What criteria would a company have to meet before I invested in it? What criteria would a company have to meet before I invested in it? Can consider the number of competitors in the market, the number of competitors in the market, the legislation that impacts on how the company does business, the legislation that impacts how the company does business, the product offering, its consumers, its fundamentals. Such as the price to earnings ratio. If the company no longer met one or more of the original criteria after I bought it, what should I do? If the company no longer met one or more of the original criteria after I bought it, what should I do? By how much would the investment's price have to rise or fall before I sold it? So your stop loss basically, or take profit level. By how much would the investment's price have to rise or fall? Price have to rise or fall before I sold it. Momentum investing is based on the thought that growing shares will continue to do so while shares that are falling in value will continue to fall. When you use this strategy, you're taking advantage of shorter term market volatility. The idea is to sell holdings that are leaving their peak in order to buy more stocks that are on the rise. So sell holdings that are leaving their peak. Sell holdings that are leaving their peak. Buy more stocks that are on the rise. However, this type of active share dealing can be quite costly. It involves making several transactions in a short space of time, which could each incur a transaction fee. Plus, the risk you'll lose some or all of your money doing this is high, so you should set aside money you use to build one. Avoid tapping into funds that are earmarked for more important things. The idea to sell holdings that are leaving their peak. So sell the shares that are like coming down, right? Decreasing in value, leaving their peak in order to buy more stocks on the rise. So buying the ones that are going up in price or up in value. Can be quite costly, plus the risk usually is losing high, so you should set money aside to use to build one. Avoid tapping into funds that are earmarked for more important things. So the questions, let me just reread through them again. What impact will this portfolio have on my ability to build wealth in the future? Would this portfolio slow my ability to build wealth in the future? I.e., is this portfolio taking up a large chunk of my wealth building? I wouldn't say it's technique, but wealth building tools or portfolio. How much am I willing to put towards speculative investments? So how much are you basically ready to lose? It won't heavily impact you financially or anything like that. What type of investments am I looking for? Here you can consider, so yeah, as a question asked, what type of investments am I looking for? So either companies in certain speculative sectors, so I think these are like the new upcoming sectors. So AI, companies small medium market capitalizations, companies listed in developing economies. What criteria would a company have to meet before I invested in it? Here you can consider the number of competitors in the market, so does it have to have not many competitors in the market for me to invest in it? Otherwise, if there's too many competitors, then it's going to be hard for the company to maybe like grow, probably. The legislation that impacts how a company does business, so there's like a law that prevents the company from doing something, then it might be hard for the company to grow again. The product offering, so what they sell or what they offer or their own products, whatever it is consumers. Is the consumers only targeting a specific age group, or can it be for everyone? Its fundamentals, like price to earnings ratio. Yep, so fundamental analysis, company reports and stuff like that. Does it have to have a specific number of people, or I don't know, whatever. If the company no longer met one or more of the original criteria after I bought it, what should I do? Do I sell it, or do I keep it and see where it goes from there? By how much would the investment's price have to rise or fall before I sold it? So this is like your stop loss and take profit levels. And yeah, so I'm not going to write this bit down, momentum investing, because it kind of sounds like you're just hoping for it to continue to go up or down, even though you don't really have an exact reason for you to know that it's going to go up or down. So just momentum, isn't it? But yeah, nope, not that. Yeah, plus the risk of you lose some or all of them your money doing this is high, so no thank you. So lesson summary then. A second tier share dealing portfolio enables you to speculate on short-term price movements of an asset. The aim is to find stocks that could experience exponential growth in the near term with the hopes of growing your money quickly. Right, okay, so growth. High prospects for growth in a short term time frame. The aim is to find stocks that could experience exponential growth in the near term with the hopes of growing your money quickly. Because it involves making several transactions in a day, week or month, it can be more costly than long-term investing. Because it involves making several transactions in a day, week or month, it can be more costly than long-term investing. I am going to leave this episode here. So in the next video we're going to go through how to manage your investments. And yeah, so thank you all for watching, and I will see you guys in the next video. Bye bye.